And there it is, the closing bell at the New York Stock Exchange, marking the end of the trading week before the long holiday weekend. The markets will be closed on Monday, July 4th. Macy's there, you can see, very excited. They are producing the fireworks show that will be here in New York City on the 4th, so they're giving us a little preview of it there as they ring the closing bell. All right, so the second half of the year got off to a stronger start. As we can see, the Dow Jones closed up more than 320 points. The S&P and NASDAQ also ended the day in positive territory. Both climbed around 1%. Joining us now is Axios business reporter Hope King. She co-authored Axios Closer, a daily newsletter on business stories and trends. Hope, welcome. Great to have you with us. So what was driving the markets up today?
Thanks for having me back, and happy 4th of July here. Yeah, I mean, I think there's a little bit of optimism going into the second half of the year. We know that history has shown that when we have a market as the one that we did the first 6 months of this year, it's been as bad it has been, down almost 21%, that the second half of the year tends to be a little better. So there may be a little bit of that playing into the markets today. We also know that home builders today, those stocks were helping the markets as well. And I think overall investors are really getting used to the new environment that we're in now, where money is more expensive, the Fed is tightening, and consumers are also more accustomed now to higher prices across the board.
And Hope, according to a report released by the U.S. Department of Commerce Thursday, consumer spending slowed in May, but inflation remained steady. What is your reaction to this? I guess the Fed was hoping when consumer spending slowed that the inflation would come down a little bit. Are we headed in the right direction?
I think we are. It will still take some time. You know, we are heading into the peak of summer. So all the spending that we were, the past year, we were spending on goods are now shifting over to services. We know travel is up. We know restaurant sales are up. So while spending may have come down in those retail stores, we know Target has talked about this. Walmart has talked about this. Everything else, the economy that was sort of slowing down or did slow down during the pandemic, they're still really, really strong. So those services areas are where we're still seeing a lot of spending happen. And so I think one thing to look for is how much that slows down as the summer tapers off. But as long as people are still going out there and spending money and spending time outdoors with friends and family, that will still remain pretty elevated. But it is, of course, going to continue to elevate those prices because the more we spend and the more workers that are still needed, let's not forget that we still are short, a lot of workers in the labor force, that workers are going to command more dollars for their wages, and that will also push up prices.
Right. So to your point about the workforce, the Department of Labor also released its weekly unemployment numbers Thursday, which showed a slight decrease in first-time claims last week. How important is the ongoing strength of the labor market to the overall state of the economy and for finally pushing back these inflationary pressures that we're facing?
They all play together. So when you have workers who are still able to find jobs, there are now about 2 open jobs for every worker that is looking for work or unemployed. That means that they still have the pick of the litter. They can go to employers and say, I want higher wages, and those higher wages then translate into higher prices for consumers. So that cycle will continue. And so one thing that some experts are looking at is if there is a slowdown ultimately in the labor market, that might actually help to bring prices down overall because workers will be demanding less money.
All right. Hope King, co-author of Axios Closer. Thanks so much for joining us. We appreciate your insight.
Thank you.